Understanding junior securities, an in-depth overview. The term junior security is crucial in the world of finance, particularly concerning investments in companies and corporations. Understanding junior securities, including their risk-reward profiles, seniority in bankruptcy, and their implications for investors, is essential for anyone looking to navigate the complex landscape of financial instruments. What are junior securities? Junior securities refer to those financial instruments that hold a lower priority compared to other securities, especially in the event of a company's bankruptcy or liquidation. Holders of junior securities are paid out only after senior security holders have received their payments. This hierarchical structure underlines the risk associated with junior securities. They are generally seen as more speculative and less secure than their senior counterparts. Key characteristics. Lower priority claim. Junior securities are subordinate to senior securities when it comes to claims on assets or income. Types of junior securities. Common stocks are the most prevalent form of junior securities. In contrast, senior securities typically include bonds, debentures, and preferred shares. Risk and reward. Although junior security holders may face significant risks, potentially receiving nothing in the event of company liquidation, they can also enjoy higher rewards, including unlimited upside potential and dividend payments. The hierarchical structure of repayment. When a company faces financial distress, understanding the order of repayment is critical for all stakeholders. In the hierarchy of securities. 1. Secured creditors. These include bondholders and lenders who have collateral backing their loans. They are first in line during asset liquidation. 2. Unsecured creditors. These may include suppliers or service providers who do not possess collateral agreements. 3. Preferred shareholders. These individuals receive preferential treatment over common shareholders but are subordinate to all creditors. 4. Common shareholders. As holders of junior securities, common shareholders are last on the list and face the greatest risk of not receiving any returns when a company goes bankrupt. The principle of absolute priority. The process of determining the repayment hierarchy is governed by what is known as the absolute priority rule. Under this principle, established by Section 1129(b)(2) of the U.S. Bankruptcy Code, senior creditors are entitled to claim all available cash before junior security holders receive any distribution. Example of junior securities in action. To illustrate how junior securities function, consider a hypothetical scenario involving a manufacturing company named XYZ Industries. Funding structure. XYZ Industries raised $1 million from investors through issuance of common stock, junior security, and obtained a $500,000 mortgage, as well as a $500,000 line of credit from a bank. Financial trouble. After assessing their liabilities, the company realizes it has a $350,000 outstanding mortgage and that its line of credit has been maxed out. Asset liquidation. Upon selling all assets, XYZ Industries brings in $900,000. Repayment order. Mortgage, $350,000 paid. Line of credit, $500,000 paid. Remaining for investors, $50,000 distributed among the common shareholders, who, as junior security holders, absorb a significant loss. In this case, shareholders experience a staggering 95% loss, highlighting the high-risk nature of junior securities. However, they stood to gain significantly had XYZ Industries thrived, illustrating the potential rewards associated with equity investment. Conclusion. Junior securities represent a critical component of the capital markets, offering investors the opportunity for potentially high returns at the risk of significant losses. By understanding the nuances of junior securities, including their position in the repayment hierarchy during liquidation and the principle of absolute priority, investors can make more informed decisions about their portfolios. Balancing the inherent risks with possible rewards is fundamental to navigating this financial landscape successfully. Understanding junior securities is vital for anyone engaging in equity investments, and knowing their implications can aid in developing robust investment strategies tailored to one's risk tolerance and financial goals.